Okay, let's dive in. Today we're doing a deep dive into, well, what many call the absolute best guide to investing out there, Benjamin Graham's The Intelligent Investor. And we're looking at it through the lens of Jason Zweig's commentary, which really brings it up to date.
It really is one of those books. It changes how you look at markets and investing.
Yeah.
Graham wrote the final version back in the early 70s, drawing on, decades of experience. And Zweig's updates are invaluable. He shows how Graham's ideas played out through, the late 20th, early 21st century booms and busts.
Yeah, it's uncanny. Reading it now, after the dot-com bubble, the financial crisis, it's like Graham saw it all coming decades early.
It really feels that way sometimes. His core ideas are just so durable.
So our mission today is simple. We want to pull out the absolute bedrock principles from this book, understand why they're still so relevant, maybe even more relevant today, and give you some practical takeaways, sort of the essential Graham blueprint. Let's get into it.
Let's do it.
Okay, first things first. Graham kicks off by defining the intelligent investor. And straight away, he says it's not about IQ points or, fancy degrees. So what is this intelligence he means?
Right. This is so crucial. He's very clear. It's about character. It's about your temperament. Things like patience, discipline, being eager to learn. Controlling your emotions is huge. And maybe most critical, thinking for yourself, not just following the herd.
So it's really about managing yourself, not necessarily predicting the future.
Exactly. And that character is what lets you draw the line between investment and speculation. Graham is super strict on this definition. For him, an operation is only an investment if, 1, it's based on thorough analysis, 2, it promises safety of a principal, and 3, it offers a satisfactory return.
And if it misses any of those, even one,
then it's speculation. Simple as that. It means you're risking your capital, maybe based on hope or market timing or just not enough homework.
And both Graham and Zweig really hammer the point that Wall Street often blurs that line, right? They kind of nudge people towards speculating.
Oh, definitely. What's fascinating here is you have to remember, Wall Street's primary goal isn't necessarily to make you rich. It's to make itself rich. Brokers, firms, they make money from transactions, from buying and selling. Activity, exactly.
Yeah.
So naturally, there's an incentive to hype up the excitement, the quick gains of speculation, rather than the, let's face it, sometimes boring patience of long-term investing. Understanding that is key.
The book is full of examples. Graham's own early experience with Savold Tire. That's a tough lesson.
Oh, brutal. He bought in, saw it rocket 250% on day one.
Yeah.
This is the early auto boom era. Looked like a sure thing.
Sounds familiar.
Totally. Pure speculation. Turned out it was basically a fraud. Stock went to zero by October. He learned that one the hard way.
And Zweig connects that straight to the dot-com bubble. Says Graham wouldn't have been surprised at all.
Not one bit. Same patterns. Remember Juno? IPO, huge spike then, poof, down to $1 a share within a year. Or that analyst predicting Qualcomm at $1,000. Stock goes nuts for a day, then collapses. People were buying stocks just because the ticker symbol sounded techie. That's not investing.
Yeah, the source even mentions the phrase reckless investors, and Graham calls it a contradiction in terms, like a spendthrift miser. Just doesn't compute.
Perfectly put. You can't be reckless and be an investor in his view. Zweig also breaks down that foolish 4 strategy from the 90s.
Oh yeah, I remember that getting a lot of press. Sounded clever.
It sounded clever. Simple even. Picked high-dividend Dow stocks based on price ratios, but Zweig calls it cockamamie. Basically, if you torture data enough, you'll find patterns that worked in the past just by chance. But that doesn't mean they'll work in the future unless there's a real underlying reason, a cause. The Foolish 4 ignored basic safety, diversification. It was speculation wearing a disguise.
So connecting this back to you, the listener, the very first step seems internal. It's about asking, am I approaching this as an investor, focused on analysis and safety? Or am I getting caught up in the speculative chase? That self-awareness is everything.
It really sets the stage for everything else.
Okay, now this is where it gets really juicy. Graham talking about the market itself, how it behaved back in the 60s, early 70s, dispelling that myth that top stocks only go up or always bounce back fast.
Right. And the sources show how that illusion got totally shattered around 1970. The market kind of returned to normal. And Graham's normal meant you had to expect significant drops, maybe long ones, not just rises. Both investors and speculators need to be ready for that.
And his famous warning about market enthusiasm.
That line is gold. Enthusiasm on Wall Street almost invariably leads to disaster, and history proved him right again and again. The 69-70 drop, 35-37% for good stocks, much worse for weaker ones. Then the 73-74 bear market, another 37% hit. He knew the market swings emotionally.
And this leads right into his idea of Mr. Market, even if he didn't always use that exact term, this sort of personification of the market's mood swings.
Exactly. Think the market is this partner you have, Mr. Market. He shows up every day, but he's, let's say, emotionally unstable. Some days he's wildly optimistic, offering you ridiculously high prices for your share of the business. Other days he's panicked, depressed, willing to sell you his share or buy yours for peanuts.
But the key is you don't have to trade with him.
Precisely. His price quote is just an offer. It's an option. It's only useful if you want to take advantage of it. You buy from him when he's freaking out and prices are low. You sell to him when he's euphoric and prices are high. Most days. You just ignore him.
And there's that amazing line in the sources suggesting you might be better off if his stocks had no market quotation at all.
It makes you stop and think, doesn't it? Why would less information be better? Because, Graham argues, it spares you the emotional roller coaster. It stops you from making bad decisions just because Mr. Market is having a bad day. His moods reflect other people's fear and greed, not necessarily the real value of what you own. If you own a private business, you'd focus on its profits, not a daily price quote.
So for you listening, how often do you check your portfolio? How much does that daily noise affect your mood, your decisions? Graham's saying, be careful, that noise can be a trap.
It's a constant test of that discipline we talked about.
Okay, so understanding Mr. Market, separating investing from speculating. It all builds up to what's arguably Graham's single most important idea, the margin of safety.
This is it, the cornerstone. It's the intelligent investor's ultimate protection. It's simply the difference, hopefully a significant difference, between the price you pay for something and your best estimate of its underlying or intrinsic value.
It's your cushion, your room for error.
Exactly right.
Yeah.
Because your analysis might be wrong, or the economy could tank unexpectedly, or just plain bad luck. The margin of safety protects you from losing your shirt when things don't go as planned.
Graham's 1972 view really highlights how it's not fixed.
Right. He pointed out that back, say, in the mid-60s, stocks often yielded much more in earnings than bonds did, maybe 9% versus 4%. That big gap was a margin of safety.
But by 72, things had changed.
They had. Interest rates were up, stock prices were high relative to earnings, that yield gap vanished. He basically said at typical prices then, stock offered no margin of safety, maybe even a negative one, compared to bonds. It shows the margin depends entirely on the price you pay.
And the sources say this applies even to things like warrants or special situations, things that seem riskier.
Yes, it's a big, if your careful analysis shows the potential payoff heavily outweighs the potential loss. If the odds are strongly in your favor based on the numbers, you can argue there's a margin of safety even there, but it always comes back to the analysis.
So connecting back to you, why is this margin of safety idea so critical? Because Graham saw over decades that consistently demanding it was the single most reliable way to get decent results over the long haul and to survive those inevitable market vicissitudes, as he called them, the rough patches.
It's job number one, protect your principal. The margin of safety is how you do it. Okay, so Graham then lays out two main paths an intelligent investor can take. Both are perfectly valid, he says, but success hinges on knowing yourself, your temperament, your available time, and sticking to the path that fits. He really emphasizes that a lot of risk in investing comes from within us.
Right. These are the defensive investor and the enterprising investor. Let's break those down. What's the defensive investor about?
Okay, the defensive investor. Their main goal is safety, avoiding serious losses, and getting, adequate, satisfactory results, not trying to shoot the lights out. And crucially, they want to achieve this with a minimum of effort, decision-making, or specialized skill.
So what should they buy? How do they keep it simple and safe?
They should really limit themselves to shares of large, prominent, financially strong companies, and companies with a long, uninterrupted history of paying dividends. That track record matters.
And financially strong or conservatively financed isn't just a feeling. He gives actual numbers, right?
He does. For industrial companies, the common stock's book value should be at least half the total capitalization debt plus equity. For utilities, maybe 30%. These aren't magic numbers, but they're quantitative tests. They provide a concrete check for financial robustness.
Okay, and what methods suit the defensive investor?
Pretty straightforward stuff.
Yeah.
Using investment funds, mutual funds, maybe common trust funds. That gives you diversification easily. He was also a big fan of dollar cost averaging, or DCA, just investing the same fixed amount of money at regular intervals.
Buys more shares when prices are low, fewer when high. Takes emotion out of it.
Exactly. It enforces discipline. And Zweig updates this by saying the ideal way today is probably DCA into a broad portfolio of low-cost index funds.
Yeah.
To basically give up trying to pick winners or time the market.
What about getting professional help? An advisor?
Graham says that's fine, but with a huge warning label. You have to do the due diligence on the advisor first. Check their integrity, understand exactly how they're paid, make sure their interests align with yours before you hand over any money. You can't delegate the responsibility of being intelligent about who manages your money.
Makes sense. And the bond side of that portfolio?
Usually a choice between taxable and tax-free, depending on your tax bracket. Safety is paramount, so stick to highly rated bonds, A-rated. He also mentioned U.S. savings bonds, which were historically very safe, though their features have changed over time.
And what should the defensive investor definitely avoid?
Growth stocks. Graham was wary because their prices often bake in very optimistic assumptions about the future, making them inherently more uncertain and speculative. Zweig drives this home with examples like IBM, Microsoft, Cisco. Even the absolute best growth companies had huge, gut-wrenching price drops along the way.
And trying to time the market. Definitely out for the defensive investor.
Absolutely. That's speculation, plain and simple.
Okay, so that's the defensive path. Safe, steady, minimal fuss. But what about people willing to put in more work?
Right. That's the enterprising investor. This is someone willing to, roll up their sleeves, devote real time and effort to research and analysis. Their potential goal is to achieve better than average returns. But Graham stresses this requires intelligent effort, not just more activity.
So what kind of activities might they undertake?
Well, they might try buying stocks when they're unpopular and selling when they're popular, classic value investing, though the sources admit it's hard work. They might carefully select growth stocks, but this requires really deep independent analysis. You have to ignore the hype, question the assumptions baked into the price, be very careful about valuation, especially if earnings seem temporarily inflated.
And the famous bargain issues.
Ah, yes, a Graham specialty. Finding companies selling for less than their net working capital alone, basically. Cash and receivables minus all liabilities. Like buying the inventory for free. His 1957 study of stocks like that showed it could work really well. They might also look at special situations, things like mergers, liquidations, arbitrage. Though the sources note these have become more competitive and complex over time, reducing the easy profits.
So this path requires more than just time. It requires a certain grit.
Absolutely. You need a strong, independent temperament. You have to be able to trust your own analysis when the market is telling you you're wrong. You can be a bit more flexible than a defensive investor, maybe look at smaller companies, but you still need to apply strict tests for quality and price reasonableness. Just buying any cheap stock is dangerous. The sources show lower quality stuff gets hammered much worse in downturns.
Okay, so connecting back to you, listener, this is a really key decision point. Which description fits you better? Your personality, your available time, your willingness to do the homework. Graham insists knowing yourself and picking the right path for you is crucial.
Your own behavior is often the biggest risk factor.
All right, let's talk about analyzing companies. It sounds straightforward. Look at the numbers. But the sources spend a lot of time warning about accounting tricks and complexities. Things aren't always what they seem.
No, they certainly aren't. Security analysis, Graham says, works pretty well for bonds or preferred stocks. You have clear standards, earnings coverage, capital structure, things like that. But for common stocks, especially valuing them based on future growth, it gets much fuzzier, much less precise, more room for error or even, manipulation.
And he wasn't a fan of overly complex math and valuation?
No, he famously cautioned against it. He said something like, the more elaborate the math, the more speculative the conclusions. He preferred simple logic, conservative assumptions, basic arithmetic you could trust, rather than fancy models built on shaky forecasts.
He even suggested a pretty simple valuation method based on history.
Yeah, the past performance value.
Yeah.
It was a way to estimate a baseline value just based on what the company had actually achieved historically, a reality check against overly optimistic projections.
So what are some specific red flags in the accounting that the sources tell us to watch out for?
Oh, there are several. A big one is those special charges or non-recurring items that, they keep recurring. The Micron Technology example is perfect. They wrote down inventory 6 quarters in a row. If it happens that often, it's not special. It's part of the business reality. You need to understand why it's happening.
So look for patterns in the one-offs.
Exactly.
Yeah.
Also, be aware if earnings look good just because the company used up old tax loss credits. That means future taxes will bite harder. pay very close attention to potential dilution from things like convertible bonds or stock options and warrants. The National General case showed how warrants could effectively double the real market price per share, but it wasn't obvious from just the basic PE ratio.
Depreciation choices can make a difference too.
A huge difference sometimes. The train example showed how changing the depreciation method could create a big jump in reported earnings, even if the underlying business hadn't changed that much. Also, how companies treat R&D costs, or whether they use FIFO or LIFO for inventory accounting. FIFO tends to make profits look better when costs are rising. These can all skew the reported numbers.
And you mentioned OPM addiction earlier.
Right. Other people's money. Companies that seem okay on the surface, but they're constantly having to raise cash by issuing debt or selling more stock just to fund operations or pay bills. Global Crossing, WorldCom were classic examples cited. You have to check the statement of cash flows. Where's the cash really coming from? Is the core business generating it, or is it just financial engineering?
Wow. It really sounds like being an intelligent investor means being a bit of a detective with the financial statements. You can't just accept the headlines.
Absolutely. Healthy skepticism is required. You need to understand the story behind the numbers. And it's not just the numbers. The quality of the people running the company, the management, and how they treat the actual owners, the shareholders. That's incredibly important too.
The sources give us two basic questions to ask about management, right?
Yep. First, are they reasonably good at their jobs? Are they efficient? You look at profitability, how they stack up against competitors. Pretty straightforward. But the second question is maybe even more telling. Are they running the company with the interests of the outside shareholders, people like you, genuinely in mind?
And that puts some responsibility back on the shareholder, too.
It really does. Graham argues that as an owner, you need to pay attention. Read the proxy statements. Don't just toss them. Think critically about what management is proposing. And if the company's results are consistently lagging, demand real answers, not just vague excuses. The source points out that something like a third of individual investors don't even vote their shares. That's like owning a house and letting strangers make all the decisions about it.
And conflicts of interest are a huge red flag. The Enron example with Fasto's side deals.
A textbook case. It just screams Graham's advice. Don't check your common sense at the door. Reading those proxies, even if they were dense, might have made you wonder, wait, the CFO is doing deals with partnerships he personally profits from. How is that aligned with my interests as a shareholder? If something smells funny.
It probably is. Okay, what about specific corporate actions? How should an intelligent investor view things like dividends, stock splits, acquisitions?
Let's take dividends first. Graham felt strongly that if a company isn't earning high returns on the cash it keeps, it should pay it out to the owners. The burden of proof, he said, is on management to show shareholders they're better off without the dividend, especially if the company isn't exactly knocking it out of the park. Give the cash back.
Stock splits. Seems like the market loves those announcements.
Graham thought they were mostly a gimmick. He said companies that do them frequently are treating investors like dolts. Fundamentally, owning 2 shares at $50 isn't any better than owning 1 share at $100. It's the same value. The Exodus example showed the stock jumping just on split news. He felt it just played to speculative instincts.
What about companies sitting on huge piles of cash, like tech giants sometimes do?
Yeah, the sources mentioned Oracle, Cisco, Microsoft hoarding cash. Seems safe, right? But if that cash isn't earning a good return inside the company, and it's not being returned to shareholders via dividends or buybacks, then it's actually an inefficient use of capital. The company's financing is inefficient, even if its operations are good. It might mean management doesn't see great reinvestment opportunities, or they're just reluctant to give cash back.
And mergers and acquisitions. M&A activity is always making headlines.
The data cited in the sources is pretty sobering. Most acquisitions, especially large ones paid for with stock, tend to destroy value for the shareholders of the acquiring company. It's often called the winner's curse. You overpay in the excitement of winning the deal. Statistically, smaller cash deals for private companies seem to work out better than big, splashy stock-for-stock deals for public companies.
So again, it's about looking past the announcement hype and asking, does this deal actually make sense for me, the owner? Is management creating value or just building an empire?
Exactly. Are they acting like prudent owners of capital or just trying to get bigger?
Listening to all this, it really feels like these principles Graham laid out, 50-plus years ago in the last edition, they hold up remarkably well through all the market craziness we've seen since.
They really do. The sources make that point clearly. Graham looked back over nearly 60 years, from 1914 to 1972, and saw that sound principles led to sound results, generally speaking. The assumption has to be that they'll continue to work, because they're based on business logic and human psychology, which don't change that fast.
And the ultimate proof is in Appendix 1, right? The super investors of Graham and Doddsville. Real people, real results.
Yes. This is such powerful evidence against the idea that value investing is somehow outdated or just luck.
Right.
Graham highlighted actual investors. Warren Buffett, Charlie Munger are the most famous ones who followed this path, who achieved phenomenal long-term records.
And what was the key thing about them? It wasn't just that they were successful.
No, the crucial point is they weren't just cherry-picked winners after the fact. They were identified beforehand based on their shared intellectual framework. Graham's value investing principles. They thought about stocks as pieces of business. They looked for discrepancies between the market price of that stock and its underlying intrinsic value. They aimed to buy when that price was significantly below the value.
The Washington Post example from the 70s illustrates this perfectly.
It's the classic case. In 1973, the entire Washington Post company had a stock market value of about $80 million. But Buffett and others analyzed the actual assets, the newspaper, Newsweek magazine, the TV stations, and conservatively estimated their combined value was at least $400 million, maybe much more.
So you could buy $400 million worth of assets for $80 million in the stock market. Or maybe even less if the stock price fell further.
That's not riskier investing, Graham would argue. That's safer investing. The huge gap between price and value was the margin of safety. It shows why things like beta, just measuring stock price wiggles relative to the market, completely miss the point about real investment risk, which is the risk of overpaying for the underlying business. These super investors actually took less risk, especially in bad markets, because they bought cheap.
It totally flips the conventional definition of risk on its head.
Risk is paying too much for uncertain future prospects. Safety is paying a low price for solid present value.
So wrapping up this deep dive into Graham with Zweig's insights, we've really unpacked what being an intelligent investor means. It's about character, patience, discipline, independence, not just smarts.
And that critical line between investment based on analysis, safety, satisfactory returns, and speculation, which is, well, everything else, often driven by emotion.
We talked about Mr. Market, understanding those daily price swings are offers, not orders, and how reacting emotionally to them is usually a mistake.
And hammered home Graham's absolute bedrock, the margin of safety, that gap between price and value that protects you, that allows for errors, that's key to long-term success.
Plus, those two paths, defensive or enterprising, knowing yourself, your time, your temperament, and choosing the path you can actually stick with. That's maybe the most important investment decision you make.
Absolutely. The principles seem simple, but living them, applying them consistently day after day, year after year, that takes real discipline, independent thought, patience.
Well, hopefully this discussion has boiled down these incredibly powerful, foundational ideas for you and given you some solid, practical things to think about.
It really is a timeless blueprint for rational behavior in the often irrational world of finance.
And maybe a final thought to leave you with, inspired by Graham and Zweig. Just take a moment next time you see market headlines or hear a hot tip. Ask yourself, is this really investing? Or is it just speculation wearing a fancy suit? And consider how Graham's simple character-first approach can act as your filter, helping you cut through that noise and focus on what actually builds long-term financial health. It's a framework worth coming back to again and again.